there's a switch. Good morning, everybody. If everyone could get seated, we'd like to get going. Hello, how are you? Everyone's got their coffee ready for a good day. My name is Ami Kassar. I'm the founder and CEO of MultiFunding, and I'm pleased and honored to be here this morning to moderate this panel. What I'd like to do is to ask each of the panelists to just take 2 or 3 minutes, introduce themselves, their companies, and then we're going to try to make this, our goal is to make this as interactive and lively as possible, so we want to leave as much time as possible for discussion and dialogue. So why don't we go ahead and start and let Sam Taussig, from the head of global policy of Kabbage, just introduce themselves.
Good morning, everybody. Thank you for waking up and starting the day with us. I appreciate that. If anybody wants to bring me coffee or federal donuts, I will take deliveries on the side of the stage. My name is Sam Taussig. I run global policy for Kabbage. A brief introduction on Kabbage for those that aren't familiar, because I see a lot of unfamiliar faces. We are an online small business capital platform. So we provide a line of credit to your American Main Street small businesses, your bakers, your auto mechanics, et cetera, between $2,000 and $250,000. We qualify these customers in about 7 minutes using a 100% automated online application, leveraging underlying and existing business data such as PayPal data, bank account data, credit card transaction, receivable data, things like that. We use, the artificial intelligence and machine learning algorithms that you all are familiar with from yesterday's panel. And we do this for all industries and all business types because they're searching for very specific project-based financing. There's a lot of confusion in the marketplace about who we are and who we're not. We're not competing with community banks. We're not trying to compete with the 7A program. We're allowing the bakers to bake so that they can get a new oven or make minor upgrades to their inventory or their operation. So thank you for joining us this morning.
Louis.
Thanks, Sam. Hi, folks. Louis Caditz-Peck. I'm happy to be here. I'm representing LendingClub. LendingClub is the country's largest online credit marketplace. So we connect borrowers and investors and facilitate personal loans, auto loans, and small business loans between them. And we're a technology company like the others here, and we operate at a lower cost by using technology, having no branches, and automating a lot of processes. And we take the cost savings from that technology, and we pass that on to borrowers in the form of lower rates and expanded access to capital, and to investors in the form of returns. Been there about 5.5 years, started the small business lending program, and now work on public policy.
Great. Thank you. Bernardo.
Thank you. Bernardo Martinez. Pleasure to be here. I'm representing Fund & Circle. I'm the U.S. Managing Director. So for those who don't know, Fund & Circle is a company actually that was founded in the U.K., and we have presence in 4 countries today: U.K., United States, Germany, and Netherlands. Similar to LendingClub, we're a lending platform. The main difference that we focus on is small business, primarily. We do small business loans, term loans, from 6 months to 5 years, and we actually focus on trying to finance those traditional Main Street small business owners, but we do it from a longer term perspective, and we're trying to do it in a affordable rates. And yes, we are trying to compete more with banks and trying to be the alternative to banks when it comes to a small business.
So just by background, my name is Ami Kassar. I'm the founder and CEO of MultiFunding. We're based in Philadelphia, so thank you for making this so convenient for me this morning. We're loan brokers. I founded the company myself 9 years ago, and we work with borrowers around the country to get them the best loans at the best prices. And in our world, around 65% of the work we do lands up being in the SBA, because even though it takes longer, we still find that the longer amortizations that the program offers are the best solutions for the clients. Maybe we can kick off today. Louis, I think you have some slides. Is that correct?
Do you have a mechanism to advance the slides?
I don't. Does anyone have a mechanism? That could be a little helpful.
escape. They're up there. Clearly, we're tech people.
Two. Maybe we'll circle back around to that. No slides? Okay.
All right, so we're gonna go without slides. We're gonna pull it off. Louis, you had a quote that you wanted to share that was came from this conference last year. Maybe you can share it with all of us.
Okay. Would you be able to just turn the screen off then in that case? Sure. So one thing that we wanted to highlight was that to frame up the discussion was that last year, thank you, in Philadelphia Federal Reserve President Harker's comments about fintech, he was asked, what do you see as the biggest benefits and the biggest risks of what's happening in fintech today? And he had really positive things to say about a lot, but one thing he highlighted as an area of concern was some of the things that he was seeing in, if not necessarily fintech lending, the associated world of non-bank and often online small business lending. And so President Harker said, I hear these stories constantly about a small business in particular getting into a situation where they didn't quite know what they signed up for, and they walk into their community bank and say, I've got to get out of this deal. It's killing me. And so there are good actors and bad actors, and that is the role of the regulators, not just at the federal level. And then President Harker went on to basically encourage us, the online small business lending and fintech industry, to be proactive and set some standards for the small business lending industry to address the problems in the market and as he put it, to avoid a regulatory overreaction. And so one of the things we want to talk about on the panel today are the ways that industry has responded to President Harker's encouragement and done some of that, including starting to pass actual borrower protection legislation. So looking forward to that conversation.
So maybe we could just take a minute and before we dig into some of the proactive and very positive things that are happening out there, if the panelists wouldn't mind just saying some of the things out there that they see that in the world, in the lending world, that are concerning to you guys. Bernardo?
Yeah.
Here we go.
Here. So I think if you think about it, one of the things that when the small business lending was after the crisis was pretty much abandoned from the bank's perspective, and a lot of new players like us entered the space. And I think there was a lot of concerns back in 2015 around, high interest rates, no clear and transparent products and things like that. And there was a lot of I would say misalignment between what the borrower wants and what the lending we're providing. And I think actually my firm, my company, as well as LendingClub, we're kind of a sponsor of a Small Business Bill of Rights, which is basically a commitment for all of us to really make sure that we are creating transparency, that we are providing the right terms, the right solution for customers. There's pressures-free sales processes, and at the end of the day, is create a more transparent environment for borrowers to obtain what they really want in order to grow their businesses. So there's been a lot of efforts. In this Bill of Rights, right now we have more than 90 companies that are participants in the market, so we feel pretty good about it. There's still a lot of work to do, and there's other efforts from other members here, like SmartBox, that Sam will comment on it, that they're actually geared towards really transparency and making sure that customers understand how much they're paying for their product, the terms, and that there's no concerns on their side when they're engaged with responsible borrowers like us. So, Sam, anything you want to add on the SmartBox side?
Yeah, thank you. So coming out of 2008, Kabbage started to serve the small dollar credit needs of small businesses that were looking for project-based financing, working capital, things like that. There is, unfortunately, in some regulatory circles and other circles, a tainted perspective of small dollar lending, and that might be a bad word in many places. And we feel that is fairly unwarranted, particularly when you look at the commercial versus consumer distinction. I've been asked many times by regulators and policy and political staff around the country, why would a small business need $10,000? Why not just borrow $80,000 or $100,000 from their bank? And that is really a failure of some folks to understand the economics of doing business as a small business, managing inventory, investing in projects that will yield a return on investment in a short time horizon. In our case, we offer products in 6, 12, and 18-month increments with no prepayment penalties, so really you can turn a 6-month loan into a 3-month loan if you really want to, and you'll actually have a prepayment benefit on that. And so we noticed this about 3 years ago, that there was some inaccurate information about the terms and the cost of small dollar short-term lending, and we sought to create the Smart Box. And the Smart Box is the straightforward metrics around rate and total cost box. Sorry, it's clunky. But what it is, it's modeled after a consumer TILA disclosure, a Schumer box. And small businesses think in different aspects in terms of terms and pricing. And so we sought to address all of those. And so the Smart Box obviously uses APR, but we also use total cost of capital, cents on the dollar, average monthly payment, because depending on the type of your business, the size of your business, and frankly the sophistication of the owner, you may be thinking about how can I take a $10,000 loan and invest that in whatever project I want to. How am I going to be able to pay for that? Many folks do think in cash accounting terms, and they say, well, I know how much money I have at the end of the month, and so this average monthly cost is a good enough metric for me. Others want to look at the total cost of capital, and so that's, if I borrow $10,000, at the end of 6 months, I'm going to be paying $11,500 in all for this product, and some can compare apples to apples on APR. So SmartBox lives in the first page of all our loan contracts with many other folks within the ILPA, our trade association, our best practices association, or right before the contract to help standardize those pricing features so that a borrower can shop between different providers and shop between different products. And so far it's worked very well. And if there are other folks in the audience that are in industry and would like to adopt it, I would love to talk to you later.
Louis, anything you want to add?
I think just that these transparency efforts are really important. A lot of people are really surprised to learn that the truth in lending standards that we're so used to don't apply in small business lending, and that many small business loans, by some measures, might be as much as 10% of small business financing transactions below $250,000 are being made today without the small business owner knowing that they're paying APRs of above 50%, maybe up to 100%, by some research as high as 350%. They don't know that those are the rates they're paying, and the regulations don't require them to disclose those payments. And that recognition of that problem by President Harker, by Governor Brainerd in a wonderful speech that she gave in 2015, and so on, has just created a really widespread consensus that the lack of transparency standards in small business lending right now is a problem. And that's why President Harker last year encouraged our industry to do something about it and set some standards and try to rein in the bad actors. And one of the messages that we are sort of excited to come back and report is that we started to do that. So one of the most exciting things I've ever been able to be a part of was just a few months ago, California passed the nation's first truth in lending standard for small businesses. This was a bill that is that slide deck already? Cool, I might go grab the clicker to show this off. Thank you. There's President Harker's comments last year that we wanted to reference, and clicking. Okay, here we go. So, and here's the list of problems in the market that Bernardo was referencing that led to the Small Business Bill of Rights being developed in 2015. And so obfuscation of very high financing costs is what we're talking about now and addressing with transparency legislation. That's the first of them. And there's others around what the Small Business Bill of Rights sought to address in these 6 rights, that direction. Okay, thank you. So the right to transparent pricing in terms is the first of this Small Business Bill of Rights, which was a cross-sector effort where Funding Circle and LendingClub got together with the Aspen Institute and the 2 largest CDFI small business lenders, Opportunity Fund and Accion and others, and set out some pretty detailed practice standards that address all 6 of these: non-abusive products, responsible underwriting, fair treatment from brokers, inclusive credit access, and fair collection practices. And these standards are not just high-level principles. In each of these, there are very detailed practice standards that the CEO of the broker or lending company has to personally check off and sign with the signature at the bottom saying they do these things.
And I think actually it's important to add that it's not only like you check once, you actually have that commitment every year. So I just recently joined Funding Circle, and basically you got to go through and actually check the box every year, making sure that you are continuing to apply those standards and recommit yourself to that transparency. So, and that's actually the commitment that we are going to the market, that we are providing a transparent product, affordable rates, and really a good solution for small business owners, so they know where they get the product, where they're getting into it, and therefore they should be able to plan their business better.
I think it might help, and we can dig into this next, just to give a real life story of just something that I encountered 2 weeks ago. I sat next to a small business owner in a diner, and I asked him about his business. If you go on the internet and you look at the SEO, there are generally small business lending portals that are dominating where borrowers go to look for money online. And I sat next to a borrower who had about $1 million to of accounts receivable. And if he was properly informed about what was going on in the market, he could easily borrow about $1 million through an accounts receivable ABL facility against that. He had gone to an online portal backed by venture capitalists, and they had encouraged him to go to a short-term online product. That his APR he was paying was 48%. I calculated it. And they had made, by my calculation, a commission of $15,000 by getting him in that product that he'd had to renew 3 times. And he was effectively paying 4 times as much as he needed to for the money and getting a third of the credit availability that he could have if he had the correct information. So there are inherently still a lot of issues out there in terms of figuring out how to get borrowers the right loan products at the right prices. And as we sit here today, despite all these wonderful efforts, there are still thousands of people on the phone, salespeople on the phone, hammering away at small businesses, strongly encouraging them to take products that amortize over 3 months or 6 months and put them into debt traps. So maybe we can now talk a little bit about some of the good things that are happening, like California and other things in the small business bill in California and what's going on in New Jersey and some efforts to protect against that.
Okay. We can circle back to the. Okay. So this is really exciting. So California passed this SB 1235. It was signed by the governor at the end of September, and this is the first law in the country that requires a lender or merchant cash advance provider or factor, for that matter, to tell the small business owner what is the APR so that they can make an informed comparison between, hey, I need $30,000. Should I take this short-term loan? Should I keep shopping, look for a bank? Should I look for a lower cost option? Should I put it on my credit card? Right now in the market, business owners are not well informed to make that kind of decision. In California, once these rules are promulgated, which is going to be a pretty extensive process, they will be. And some things I want to highlight about this is it was really popular. On the left here are the logos of the coalition that supported this bill, which includes Funding Circle was a leader in that, as was LendingClub, as were really all of the consumer advocacy and small business advocacy world in California, from the California Reinvestment Coalition, Greenlining, even the NFIB was a supporter, and local community development groups and chambers of commerce and so on. And on the right is the initial vote is that the Senate vote? The Limon?
Yeah.
No, that's the Assembly. That's the Assembly. At this point in the vote count, it was 56 to 0. It ended up being 72 to 3. Bipartisan issue. Everyone cares about protecting small businesses, and everyone cares about transparent disclosure in the marketplace, because transparent price disclosure is the basis of a free market and of competition that is going to be able to compete on price and drive costs down. So we're excited about that. There's a bill that's underway in New Jersey right now. It's not really on the right track right now. It does not include APR, so it is in its current state. It would basically just be validating the low standard of disclosure that exists in the market today. So we're hoping that that bill will improve and get on track to include APR, so that it does actually address the problem, which is a lack of APR disclosure, and create more transparent practices, which is what industry wants. Everyone on this panel is supporting APR disclosure and transparency, because we all have confidence in our products and are all trying to help small business owners make the most informed decisions they can make.
Sam, do you have anything you want to add before we go to Q&A?
Yeah, you asked about other interesting things happening in the marketplace. So we're talking about disclosure right now, but there is a ongoing data revolution within the open banking context. So one of the reasons that many small businesses still struggle to access credit is their lenders do not understand what is really happening. There has been this wave of open banking and open banking reform in Europe through PSD2 that is slowly starting to trickle over to the United States here and take hold. Kabbage is most excited about this because it really is democratizing a lot of the inconsistencies and incongruencies that small businesses face when they go to a lender and try to explain, here's what I'm doing, here are my 3 statements. So what do I mean by this? Well, the availability of your data as a customer and your ability to share that with any lender or other fintech or institution that you want can really equalize the playing field between the most sophisticated business owners and emerging businesses, or small sole proprietors, or other true 2 to 3 employee companies, by leveraging things that you're already doing. So Kabbage has been very active in the Financial Data and Technology Association, pushing for regulators to, including the Federal Reserve, to come together at the federal level and discuss how can we act on the spirit of Dodd-Frank 1033 that says you own your own data and can share that in a way that is safe and sound for banks to share with fintech companies, in a way that customers know what data are being shared, why and when. And allow lenders and underwriters to access some of the more granular data around different financial products to equalize that playing field. I think that at the end of the day, you will see the cost of borrowing decline as the availability of data increases in the marketplace. If you are particularly interested in this issue, I encourage you to find me after. As well as visit the FData website. We've issued the standard principles and technology principles for how this may occur, addressing the tech issue, how do banks and fintech companies talk to each other in a safe and secure way, the liability issue, what happens if data are breached from the system or if there is data loss or leakage, and the traceability function of that, which is if I know that there is a breach or I know that there was leakage and we need to make a customer whole, how do we assign that liability, since the traceability function. But we're very bullish on the open banking environment in the United States over the next 5 years.
Anyone else before we go into Q&A?
Yeah, I would say that not only open banking. I mean, we actually, as a company that operates in Europe, we're starting to see the benefits of those elements. Not only actually provide better access, but also lower costs. So at the end of the day, kind of create actually a much better process for borrowers. But the one thing I would like to add is, the open banking area is important, but also having access to, financial statements, which is something that, the government can help us get better. That'll be a great thing for us. I think, in our case, we use business taxes and personal tax returns in our underwriting processes. So today, we don't have a very efficient way to collect that information. So it will be great if the government can help provide that support for fintech companies to be more, faster, more accessible to get that information with the consent of the customer, but in a way that enables us to do faster decisions. So that's the other element that I'd like to point out. There's not only banking data, but also financial tax information or any other information that the customer its own that actually can help make a better and informed decision from a lending perspective, which should result in more access to credit.
Just to draw a point on that too, a bill at the federal level to require the IRS to create an API that would allow a small business to give permission to a lender to get their data instantly and digitally has passed the House 414 to 0. Everybody likes it. It's in the Senate. It's just awaiting a Senate vehicle. There's just a couple senators on the Finance Committee that just need to make a decision to move forward, and we're really hopeful that Senator Portman, Senator Hatch will be able to get aligned and get this thing passed.
Now we're going to go ahead. We have about 13 minutes left, and we really want to make this a discussion. So if anyone has questions or points they'd like to raise, please raise your hand. Let's go. Yes, sir, back there. Yes, ma'am. I'm sorry. I didn't see. I apologize. I can put my glasses on.
My name is Janet Rufus. I'm the chair and CEO of Montecito Bank and Trust, a $1.5 billion bank in Santa Barbara, California. And my question is, are each of you signatories on the Bill of Rights?
We are, in my case.
We are.
Kabbage is not?
No.
Can you talk about why you chose not to sign it?
Yes. So we created the Smart Box in parallel to the Business Borrower Bill of Rights as a way to put into action many, if not most of the things on the BBOR. Quite frankly, there are some industry squabbles about some of the specific interpretations of BBOR. And we have many times through our association and other allies offered to work with the BBOR folks. We're very open to signing it at some point, and if we work through some of the specific points. But we do believe that SmartBox incorporates all of the key functions and disclosures that BBOR asks for in a way that is much more standardized for our borrowers, our small business 3 to 5 employee borrowers to understand and digest.
Other questions? It's early. Yes, sir.
Hi, Todd Baker from Columbia. So I wanted to ask the group here, one of your competitors, OnDeck, has moved pretty aggressively towards becoming essentially an enabler of banks' micro-lending and small business lending through its software offerings, similar to what was discussed yesterday at the consumer end. And how do you view that, given the cost of capital advantages that banks have, which theoretically can be passed to the customers? How do you see the future of small business lending in a finance company environment, which is what we see today, as opposed to potentially using some of this technology to encourage the banking system to do more?
Take that. I mean, actually, I think in the future you will see more partnerships between the fintech players and actually the normal banks. I think at the end of the day, we are providing a better solution. At our Funding Circle, we actually partner with banks as well. So we actually have a partnership with that Intrust Bank in a very different way than what OnDeck is doing. And we're seeing a great success at this point. In our case, because we're a platform, the banks actually kind of operating both sides. As an investment, they actually buy the loans that we actually originated, and now we're starting to do more co-marketing efforts in their regions to actually provide, products that today they don't offer. So what I see is the banks are going to realize that the small business is a very particular segment, requires a lot of dedication, and they haven't spent the time or the efforts to make it real, and therefore the best way to address some of those needs in the geographies they operate is to partner with fintech players that are getting at scale, and actually they're developing an expertise.
All of the peanut butter and chocolate benefits that people talked about yesterday of bank fintech fusion apply very, very much in small business lending. I think that's a direction this market's definitely going to go, and which Governor Brainerd in her 2015 speech, community banks, small business credit, and online lending talked about. The potential there is really massive. Something that I want to emphasize that I think about when I think about the future of fintech business lending in the bank environment is, what is it that banks are going to take from online lending and bring into the banking environment? The potential to lower operating costs and to make it cost effective to make these, Sam was saying, a minimum loan amount of $2,000. That's wonderful. That's a really good thing. And so there's massive potential. On the other hand, there's some things that are very common in online lending, which sort of get conflated as being innovation, but they're not actually innovation. I would say that just offering a shorter term, like a 6-month term or a 9-month or 12-month term, that's not necessarily innovation. That's just a shorter term. Just charging 50% APRs, 75% APRs, that's not innovation. That's just having a high price so you can accommodate higher losses and pay for the high cost of originating smaller loans. So I'm hopeful that as banks start to adopt these, they're not just going to say, hey, our fintech solution is we're offering short-term high-cost products. Their solution is going to be actually using technology to offer really good, solid, affordably termed, affordably priced loans that use all the data that Sam was describing to be really insightful about what's going on in a small business and figure out what's the right product to serve that small business.
I think there's an enterprise risk aspect to this as well. Kabbage works fairly extensively with large financial institutions abroad to service their underwriting platforms. In the case of ING, we operate in Spain, France, and Italy, underwriting most of their small business working capital loans in those countries below 50,000 euros. The reason we can do it so successfully abroad is partially some of the regulatory acceptance around working with third-party vendors and companies to co-develop credit boxes and underwriting algorithms. The European Central Bank, the European Banking Authority, and the prudential regulators in each country are very involved in this process. They're very aware of what's going on, and quite frankly, they are pretty hands-on and understand what the actual risk is and frankly, what the risk isn't. And so we commend our European regulatory counterparts for being so active and allowing these kinds of partnerships to develop. In the United States, it's been much more difficult, both internal to the bank and with regulators. Some of that is going to require updating the OCC's third-party vendor management risk guidelines. There is certainly an education gap happening around, what is AI, what is machine learning, what's actually happening in these underwriting algorithms. And on the bank side, it's quite frankly a technology culture issue. I'm not going to stand up here and say that banks have bad tech. They actually don't. They have slightly disorganized tech. So to allow us to fully underwrite their program or their customers, that's a very hard thing for them to give up. There's a lot of legal, regulatory, and enterprise risk fear, some founded, some unfounded within that. It's an ongoing dialogue with U.S. partners, but we hope that we can learn from some of the European counterparts.
I think it just might be helpful to put some of this in context, where for the borrower, a lot of it, if you really think about the cash flow impact of these loans. So if a borrower goes, and the easiest and the fastest loan to get is a loan that amortizes, to Lewis's point, over 6 months. Say you borrow $50,000 and you take a loan over 6 months, the lender's going to take somewhere around $600 to $650 a day out of their bank account, which is very, very hard to keep up with. If you're going to do that over 3 years, the lender's going to take approximately $1,500 a month out of their bank account, which is a lot easier, $1,500 a month versus $650 a day. Now, if you want to go through the pain in the rear end of getting an SBA loan for that, you can have a monthly payment of about $600 a month for 10 years. So the differences in price and the impact of these small businesses is really incredibly dramatic. And sometimes the convenience and speed and the desire to just get it over with quickly leads them to the faster product.
Well, you make it sound like it's a painful pill. I mean, it depends on what your investment horizon is. If you have an inventory investment that you want to flip in 6 weeks, then a short-term loan makes sense. If you're gearing up for a large event, you need to stock up, maybe you need to publish marketing materials. You know, this is exactly the use case that we serve. I agree that if you're taking out $100,000, you know, with an investment horizon or $200,000 beyond 2 years, then you should absolutely consider looking at community bank products or going to a 7A process. We're a big fan of the SBA, but let's not discount some of the short-term use cases and capital needs for small businesses.
Yeah, but at least from our experience is that we find that there should, in my opinion, there should absolutely be products out there for when those short-term needs are there. But sometimes the short-term needs don't work out exactly as planned. And when they don't, and then the borrower is stuck with that very intense payback pressure, it gets very difficult. Other questions? Yes, sir. Go ahead. I got you.
Nat.
I'll just project Nat. Do you have any insights, Bernardo, on the ability of fintech loans to reach underserved communities or Lewis compared with traditional products?
So, sorry, I'll use it because I know they're recording. Just the question was the ability of fintech small business loans to reach underserved communities, maybe compared to traditional products in places where bank branches have pulled back. Or,
You know, I think based on my previous experience, we have seen that and I think actually they showed it here yesterday. You know, in PayPal, there's a lot of efforts. Online lending is really kind of covering that gap where branches are being closed. And, you know, we haven't done the study for Friend and Circle, but at the end of the day, we see every time that when we talk to borrowers, they're telling us, well, we're looking for you to help us because we don't have a branch nearby us. So we're seeing that every day when we talk to borrowers. So yes, definitely online is serving that gap that as branches have diminished across the United States, and that's definitely something that we're looking for. I mean, that's happening, and we're happy to serve those communities, to be very honest.
When compared with the portfolios of traditional bank conventional lending, we see about 5 times the representation of minority-owned businesses, about 4 times the representation of women-owned businesses. 7 out of 10 of our borrowers tell us they were not otherwise accessing affordable capital. And so the potential for a fintech approach to reach underserved communities relative to what the banks are doing is significant, it's massive. And Sam was talking about Dodd-Frank Section 1033. To plug another, there's Dodd-Frank Section 1071, which would create HMDA-like disclosures and data collection for small business lending. And we think that would be a really wonderful spur to innovation, because right now, as y'all as researchers know, no one really knows actually how much small business lending is happening and to whom and what terms. We have a pretty weak proxy of CRA loans of less than $1 million, but that's the best we've got. And if Section 1071 were implemented, it would show for the first time what actually is working at reaching underserved communities and small businesses, because some things are working right now and some things are not working. And if you get that transparency into what's working, that will create a lot of ability for the market to move towards what works. There'll be a lot of investment that gets drawn to the models that works, and there'll be the transparency for the parts of the market that are not doing a great job reaching women and minority-owned businesses, basically the conventional banking sector, to see, hey, here's what does work, and here's what we should invest in, whether we're building our programs internally or partnering, buying fintechs, who knows what it'll be in whatever form of that chocolate peanut butter, or whether it's working more with community development, financial institutions, or things like that. That would be a great spur to innovation, and we encourage the CFPB to get along and do it.
Yeah, Nat, on the quantitative side, Kabbage and a couple other lenders in the space and platforms, we participated in a national economic impact study. And we found on average that Kabbage's loans produce about $3.70 in gross economic output for a small business for every dollar we lend. We're very proud of that statistic. It's actually rather on par with the revenue increase data we see because we have live and persistent granular access to data for our small businesses. We're pulling that data in from those core counts every night. We see, you know, as the borrower goes through a 6, 12, or 18-month loan, we see approximately the same increase in revenue. So, you know, there's some substantial evidence out there that small business lending in the platform context that we're doing is creating real economic value. I agree, and I'm sure all the Federal Reserve economists in the room would also agree that we would love to see more quantitative, holistic research on this across the country.
I think we're out of time. So thank you, everyone, for being around. I know we'll be around to chat. So thank you very much. Thank you.